The best investment you've never heard of. By Lion Property Group. Foreword. We open this book with a confession. Its title is exaggerated. There is no such thing as a universal best investment. There are a variety of goals that investments can serve. Something that is the best at achieving one goal is doubtless terrible at achieving another goal if those goals are opposing or contrary. And so an investment that is the best for one person would be awful for a different person. But you wouldn't have downloaded this book if the title was up front. An investment strategy that may be right for you depending on your needs and circumstances isn't as catchy. But we are confident that you haven't heard about the investment strategy we are describing in this book. 87% of our clients had no idea it existed before they met us. Now that we've got your attention, the rest of this book will be free from grandiose claims and unsubstantiated promises. There are countless resources on the internet that promise the world and deliver little to no value. That is not our intent. We present our case with self-evident reason and argument. Whether you agree with our evidence and our arguments is up to you. But at least you'll be able to make an informed decision, a decision that is data-driven and researched. As a company and as individual people, we value honesty and transparency. These two traits are the foundation of healthy relationships. You don't get very far without other people, and people won't want to work with you if they don't trust you. So we'll be upfront. The intention of this book is to show you that our investment model is a great method to achieve certain investment and financial goals. But we want you to make the decision for yourself, and we're not going to distort or misrepresent the facts to make us seem like something that we're not. That's not how you build long-lasting relationships. If we're not what you're looking for, then so be it. We wish you luck in finding an investment that better aligns with your goals. But if by reading this book, you think that our investment model may be able to serve you, we'd love to help you. Here's to your success. Chapter 1. What are the common investment goals? While there is no single best investment, the strategy that is this book's focus is adaptable. Depending on how you choose to structure the investment, it is possible to achieve a variety of different investment goals. When you are looking to invest, it's vital to understand why you're investing and what your motivating goal is. Ask yourself which of the goal archetypes outlined in this book best describes your motivation to invest. Once you know what your goal is, you can evaluate investment options in the context of how efficiently they will achieve that goal. There are two main ways that an investment can make you money. The first way is to generate an income, which is called passive income. The second way is to grow in value, so it can be resold for a profit. This is called a capital gain. Many investments do both to varying degrees. For example, an investment property does both. By renting out the property, you generate passive income via rent. But the value of the property is also changing, creating the possibility of capital gains when you resell the property. An investor who wants to maximize long-term profit will tend to invest in owning valuable assets and rely on capital gains. But an investor who wants short-term benefits will focus on investments that generate regular passive income. Which of these approaches is superior depends on what your goals are. So let's begin by exploring the common types of goals that investors have, and later, we will explain how our strategy can serve these goals. Goal 1. I want to grow my wealth as much as possible. Some people invest with the sole purpose of growing their wealth as much as possible. Everyone invests to grow their wealth. That's the point. But investors with this goal want the highest performance, the most growth, with little regard for any other factors. Investors with this goal are usually highly illiquid, which means that their wealth is tied up in assets and investments. For these investors, illiquidity is acceptable because they want as much of their money as possible working to generate more money, and liquid cash generates so few returns that it may as well be nothing. As a result, most of their wealth is tied up in investments, usually many different types of investments in a variety of asset classes. They can also be highly leveraged, meaning they have high levels of debt. By borrowing further capital, these investors can also have other people's money working for them. Let's say you have a loan where you pay interest of 5% per year. If you're able to invest that loan money into something that pays 10% per year, you are still making a profit of 5% even though you're in debt. This does, of course, have more risks. For these investors, factors like the frequency of distributions, liquidity, and even risk aren't a concern. Their fortune is like a high score, and they always want the number to be getting bigger. Despite what the mainstream media and films like The Wolf of Wall Street portray, in our experience, very few people fall into this category. Most people who may appear to fit into this group actually fit into the next category. Goal 2. I'm saving for something big or to reach a particular milestone. These investors are also investing with the purpose of growing their wealth as much as possible. But the difference is that these investors are doing so in pursuit of a specific goal that is a long time away. Some common examples of this are people who are investing for their retirement or investing on behalf of their children. In these cases, their investment time horizon is decades away. Another example is a young investor who has recently started working but is conscious of saving for retirement. Their retirement could be 50 years away. These investors are not particularly concerned about their current situation or liquidity, as long as their intended beneficiaries will be in a stronger position for it. If you aren't going to access the returns from your investments for 50 years, you don't care about any immediate benefits. And these investors are generally tolerant of risks, because they have decades to correct for any bad investments they make. But as the endpoint gets closer, they will become more risk-averse. If your time horizon is only 5 years out, that may not be enough time to recover from a risky investment that goes wrong. For an investor in this category, their particular needs and requirements in an investment product will change depending on how far away their endpoint is. Goal 3. I want to supplement my income. When we surveyed our clients, over 32% stated their primary motivation behind investing was to supplement their income. Considering the events of the last few years, it's understandable why people would want extra income as a safety net. Rising interest rates and the increasing cost of goods have left Australians with tighter budgets and less disposable income. Many households are living paycheck to paycheck with little opportunity to build up their savings or improve their quality of life. For investors who are seeking to supplement their income, the net return is not as important as the frequency of distributions, the length of the investment term, stability, and the ability to withdraw funds at short notice. Yes, all else being equal, a high return is still better. But an investor looking to supplement their income will forego a higher return in the long term if they get benefits in the short term, namely passive income. Goal 4. Paying down debt. It may seem counterintuitive, but choosing to stay in debt and invest can actually leave you in a better financial position than making a big lump sum payment towards the debt. In some instances, it can even pay off the debt faster. As mentioned earlier in this book, if you are paying 5% interest on money which is generating you 10% per year, you are still making a profit of 5%. So some people will choose to borrow money for the sake of investing, or hold off on paying down their mortgage and use that money to invest instead. This is an inherently riskier strategy than just paying off the debt, because if the investment doesn't pan out, you've lost someone else's money. But it will leave you in a stronger financial position if you can successfully manage it. Chapter 2. Introducing property development. Before we can start explaining how our investment model helps investors fulfill each of the archetypal goals, we need to explain what our investment model actually is. Property development is a business strategy that includes a variety of practices designed to increase the value of a property so that it can be resold for a profit. On a smaller scale, this may include activities such as the renovation and resale of pre-existing properties, which is colloquially known as flipping houses. On a larger scale, this includes activities such as converting an established dwelling into multiple smaller dwellings or building on unused land. A property developer is not a builder. Property developers are the people who oversee and coordinate all of the tasks and contractors required to complete the property development. This includes construction, but also includes other tasks such as site acquisition, design, permits, and much more. It's also important to understand how a property developer makes money. Many people are familiar with the traditional property buy and hold strategy and assume that property developments make money the same way. This is true, but it doesn't fully cover it. With a buy and hold strategy, the asset does not change, but its perceived value does. What you own is identical to when you bought it, but market factors have changed the demand for the asset, and so the price is different. This is like buying stocks in a company. If you buy 100 shares in a company, the value of each share may change, but you still only have 100 shares. This is known as a speculative investment. In the case of property development, the asset does change. As an example, if you start with a single detached home and develop it into 6 townhouses, you have fundamentally changed the asset. You have changed one thing into another thing, and the new thing's value is separate from the old thing's value. This is like transforming 100 shares in one company into 150 shares of another company. We refer to this as a value-add investment. The benefit of property development over a buy and hold strategy is that the developer is able to directly adjust the value of the asset themselves, rather than being entirely dependent on market forces to make a profit. While a strong market helps and will result in more profit, a property development can still be profitable even in a declining market. There are a variety of factors other than the final sales price that also influence how much profit a particular development will generate, such as the purchase price of the land, contingency in the budget, construction costs, and loan interest. As a result, we believe that property development has a place in every investor's portfolio to diversify away from purely speculative investments like stocks, which are susceptible to market volatility. Outside of undertaking your own property development, you can also choose to invest in someone else's property development and make a profit that way. This is Lion Property Group's business model. We allow other parties to invest their capital into our projects and we undertake the developments on their behalf. Chapter 3. How our model serves the 4 archetypal goals. Now that you have an understanding of what our investment model is and how it works, let's look at how it can specifically serve the goals outlined in Chapter 1. Goal 1. I want to grow my wealth as much as possible. Our current investment model offers investors a 12% per annum return paid in monthly installments. There is also a profit share distribution available if you invest more than $250,000. For the sake of simplicity in these examples, we are not including any profit share distributions. Let's assume you invest $100,000 into one of our projects, since it's a nice round number. You would receive 12% per annum over a 3-year investment term, so a total net return of 36%, which is $36,000. Once your first investment ends, you can decide to reinvest the original amount, plus the $36,000 return. Let's assume the same duration and rate of return. After 2 investments and 6 years, you would have received just under $85,000 in returns, bringing your total cash amount to $185,000. This is a net return on investment of 85%, which is a good demonstration of how compounding investments can rapidly grow your wealth. Let's see how much extra growth there is from compounding by reinvesting another 3 times. This brings the total number of investments to 5 over a period over 15 years. By this point, your original $100,000 has grown into $465,258. This is a total net return of 465%. Goal 2. I'm saving for something big or to reach a particular milestone. Now, let's take the figures from above and apply them to the context of someone who is saving for their retirement. Let's say you have invested 7 times over a period of 22 years, bringing you to a total of $860,542. You invest for an 8th time, but this time will be different. Rather than saving the monthly distributions so that you can reinvest them, you are going to use them as passive income. Remember, our investment model pays monthly distributions at a rate of 12% per annum, which is 1% per month. 1% of the $860,542 investment is $8,605 per month, or $103,265 per year. According to the Association of Superannuation Funds of Australia, a couple requires $62,237 per year to live a comfortable lifestyle, or $40,656 per year for a modest lifestyle. These figures assume that the retirees fully own their home. The $100,000 plus of passive income from our model is well beyond what is needed to indefinitely fund a comfortable lifestyle. Goal 3. I want to supplement my income. This is the goal that is best served by our investment model. We pay investors a return of 12% per annum in monthly installments. So if you invest $100,000, you will receive $1,000 each month in passive income. If you invest $250,000, you will receive $2,500 each month, and so on. The more you invest, the higher your passive income will become. Goal 4. Paying down debt. Let's use an example to demonstrate this. Keith's grandfather passes away and Keith finds himself the beneficiary of a $250,000 inheritance. His grandfather was an immigrant who worked himself to the bone and saved every cent he ever earned. To honor his grandfather's legacy, Keith decides to use the money responsibly, rather than blowing it all on a German sports car and similar accessories of a midlife crisis. Keith decides that the best thing he can do is pay down his home loan. Keith owes $400,000, and after making a $250,000 contribution, he has brought the balance down to $150,000. By doing so, he has significantly reduced how long it will take to pay off the loan, thereby reducing the amount of interest he'll pay over the life of the loan. But there's another way. Let's imagine a second scenario where Keith invests the $250,000 for 3 years at a rate of 12% per annum, so 36% in total. After 3 years, Keith now has $340,000. He takes the extra $90,000 that his investment generated and puts that towards his home loan and reinvests the $250,000 again. For the sake of simplicity, let's assume it's the exact same duration and rate of return, 36% over 3 years. After 6 years, Keith has contributed $180,000 towards his home loan, but he still has the original $250,000 which he inherited, so his overall financial position is much stronger. Keith can repeat this process over and over again until his home loan is paid out and he is debt-free with a $250,000 nest egg which he can continue to grow. In this book, you have learned how our investment model can be used to serve 4 archetypal investment goals, which are growing your wealth as much as possible, saving up for something big like retirement, supplementing your income, and paying down debt. Whatever your investment goals are, our model can be adapted to help achieve them. You've been listening to Lion Property Group's The Best Investment You've Never Heard of. For more educational content like this, or to view our latest investment opportunities, visit the Lion Property Group website.